Hello, and welcome to the February Market Update webinar. My name is Dan White, one of ARK's Associate Portfolio Managers, and I will be moderating today's call. This call was pre-recorded on February 20th, 2026. With that, I will now turn it over to ARK CEO and CIO, Cathie Wood. Cathie?
Thank you, Dan, and thank you everyone for joining us. We keep talking about this wall of worry, this bull market that is climbing a wall of worry. Those are the most durable bull markets, even though they can be disconcerting from time to time. And of course, the AI scare has been the latest fear in the market. So Frank and Joseph and Brett will address those concerns. I'll just summarize by saying that we have been doing AI research since ARK was founded in 2014, and we believe we're in very early innings still. We like the idea, though, that there is fear, because having been in the tech and telecom bubble myself, back then, investors were just throwing money at anything .com or internet. And there was no consideration when it came to cash flow, valuation. That is not true now. And I think some of the breakthroughs in AI, even recently, are astonishing us. Every day, we have people within ARK showcasing some of their own breakthroughs, especially on the research side. And we're all astonished. So we've just begun, and we think that we're surfacing some of the productivity gains that are going to propagate throughout the economy during the years ahead. And you know, if you've been tuning into In the Know, that we believe we're moving from a rolling recession into a productivity-driven boom in activity. And I think that it will be very obvious by the midterms this year. We shall see. We've got tax cuts, we've got deregulation, we've got technology breakthroughs in 5 platforms at the same time: robotics, energy storage, AI, public blockchains, and multiomics technologies. So, and these breakthroughs are helping S-curves feed one another as these technologies converge. So we think we believe that the next few years we will see astonishing growth, and that inflation is going to surprise on the low side of expectations. And this is just one thread I'll pull from In the Know. Trueflation, a metric that we've been following closely, it peaked in 2022 at 12%. It's a consumer price inflation metric, monitoring in real time 10,000 different goods and services. It is now below 1%. So like the CPI, it was wrestling with that 2 to 3%, or in that 2 to 3% zone for 2 to 3 years. It has broken down, and we do believe that the traditional measures will follow it. So the surprise is on the low side of expectations when it comes to inflation, and perhaps interest rates in the short term, until it's clear that we're in a productivity-driven boom. It is very interesting that one of the Fed members, Miran, who is a voter, he has shifted from expecting 150 basis points of cuts during the next year to 100. And I think the narrative is evolving here that if interest rates are not going down because growth is very strong, that's okay. That's good news. That's the market working. So with that, Dan, back to you.
Thank you, Cathie. Before we do Q&A today, I'm going to do something a little bit different this month. ARK's funds have hit this 5-year number, which is a well-followed number. And the start of that number is the peak of the COVID high. So obviously this is a highly endpoint sensitive number, but nonetheless, it's one that allocators follow. So it's important to just take a moment and kind of review. First, a sincere thank you to all of the investors that stuck with us through those ups and downs. In client conversations, what we have found are those clients that have had the most success are the ones that actively manage the position that they have to ARK, right? Taking profits on the way up and averaging in buying into dips. And psychologically, both of those are difficult. So we've published some content on our ARK Funds website to bring to life through visuals just some of those rebalancing strategies. Next to touch on is we have a catalog of content on that boom bust, right? And a lot of it is archived in this video series. What happened, why it happened, and what we learned. So I'd encourage everyone to watch those. But for this video, we'll focus on where we are today. And as Cathie mentioned, what we've seen over the last few weeks has been a panic of AI, an incoming disruption, sell first, ask questions later type of market. And our research suggests that over this next business cycle, the lion's share of market value appreciation will come from innovation, with AI as that central catalyst point. And ARK Invest has focused a part of its research since founding on artificial intelligence. And a lot of these names are the lesser known, pure play names that you may not know today, but we think become household names over this business cycle. So from an investor's stance, and consider the source here, Mr. Market, in our view, is handing investors an opportunity, right? It's woken up to the fact of AI, and it agrees with us. AI is coming, and the opportunities and disruption that come with that. So the time for active management is now, because business losers and winners will emerge faster than they ever have before, with the winners likely seeing that exponential growth. And so to maybe just step back and think about from your own portfolios, and the hardest part tends to be sort of starting the allocation. And we hear that from clients, and we hear a wide range of how clients allocate to these funds. But most seem to start in sort of this 3 to 7% range. And this is certainly based on an individual risk tolerance and time horizon. But importantly, those clients manage through the volatility through rebalancing. So that disciplined approach in a total portfolio will help you, mitigate volatility. And then the allocation also provides you with a hedge to disruption, a hedge against disruption, and an opportunity for exponential growth. So for most of you listening, a 3 to 7% range tends to sort of fall in the satellite bucket. And that's where you should be taking risks, right? And I would personally bet where the broad indexes are and where maybe precious metals are, you may have some places to trim profits and rotate into those satellite opportunities. And so you've heard it before, but I'll say it again. There's no better time to invest in the future than the present. But I would add to it that that's especially true when the market is handing out a discount. So thank you again to all of our investors and all of the supporters of ARK. And with that, we'll begin the Q&A portion of today's webinar. Questions were received from our clients and distribution partners and sent to our Funds X account and Instagram account at ARK-Funds. So this first one, I'm going to go to Frank and Cathie, as Cathie promised in the intro here. Frank, the market is panicked that AI will destroy software, and this might just be the start of things. So just open-ended, what is your view on that?
Sure, Dan, I'm happy to start with this one because I think it's a really important topic driving a lot of narrative in the market today. And you can see the reaction in a lot of publicly traded software companies that are being re-rated based on fears that AI is going to disintermediate their business model. And while I don't think AI is going to destroy software, I think it is fair to say that it's transforming it, and it's transforming how it's created. We're seeing AI coding agents like Claude Code and competitive offerings from OpenAI and Google dramatically lowering the cost to create software. And rather than just eroding the revenue base of companies like Salesforce overnight, or every enterprise deciding to build their own CRM, I think we're more likely to see heightened competition where Salesforce and all of their competitors have to adopt AI to stay competitive, and a whole new crop of startups are going to try to attack similar types of problems using AI in a very native and novel way that may change the forward revenue growth potential and pricing power of these incumbent software companies. And they will have to adapt and enter, what we call the token supply chain to be able to stay relevant, where they're involved in some way in taking this new form of digital intelligence, AI tokens, and using it in a context like sales workflows to be useful to enterprises. The businesses that do that well, I think, have a huge market opportunity in front of them, and the businesses that don't, I think, will be in disintermediated. And we're seeing this play out, particularly, I think, companies with a usage-based pricing model relative to a seat-based pricing model are already ahead of the game, and we've positioned our portfolio accordingly. And then also, we're seeing strong demand for AI compute across all of the clouds, where we've seen AWS, as in Amazon's most recent earnings quarter, accelerate from 19% to 24% year-on-year growth. That's a $140 billion annual business. Growing at 24% is quite remarkable. And then Google, for example, their cloud division is growing 48%. It's the fastest growth rate of the big three clouds. So there's clearly strong demand in the market for AI that will create, we think, a proliferation of opportunities. And we're continuing to follow, in the public markets where we think there will be winners and losers, and positioning the portfolio accordingly.
Yeah, and I'd like to add that our research team has done an amazing job in anticipating the kind of shifts in the technology stack that are happening now. I think 2 years ago, or maybe it was last year, we posted a graph in Big Ideas. I think it was Big Ideas 2025, showing the tech stack. So you have infrastructure, so chips and data centers. You have platform as a service, Palantir being the poster child of that part of the stack, and then applications. That's where SaaS falls. And we took note that in the last 5 years, the incremental growth had accrued more to infrastructure and platform. We had applications growing nicely, double digits, but ceding some incremental share to the other two parts of the stack. I think what we didn't anticipate was that growth rate in applications would start to slow fairly significantly in some cases. And so this incremental growth shift toward the other two parts of the stack is happening faster than even we thought. We protected our portfolios from software as a service, knowing that was the part of the stack that probably was most at risk of this disruption.
Thank you, Cathie, and thank you, Frank. This next question here, we'll move to Brett. So Brett, is the SpaceX acquisition of xAI a positive thing heading to a potential IPO for SpaceX? And then part two to this question, going one step further, if SpaceX and Tesla merge, would that potentially limit upside potential for Tesla shareholders?
We believe that kind of the xAI SpaceX merger is a win-win for both SpaceX shareholders and xAI shareholders. The way to think about it from the SpaceX perspective is the launch volume required to support AI compute is literally in more than an order of magnitude larger than the launch volume required to support their Starlink satellite constellation, which is extremely cash flow generative right now. So SpaceX had determined, given that business opportunity, it was going to place a wager that launching, kilowatts into orbit was they're going to use a lot of capital to do that. And so even prior to the merger, they were beginning to line up for an IPO to raise capital to invest in launch towers and launch rockets and AI compute satellites and begin lofting satellites into orbit. And we think that's a great business move. In fact, if you look at what AI compute costs, it's on the order of $10,000 per kilowatt of compute to get access to these great computers. That's what companies have to pay. And we think as it scales, SpaceX will be able to launch compute into space for around $1,000 per kilowatt. So it could be actually a very nice business opportunity for them that could grow very large. But they wouldn't capture the upside of turning that compute into intelligence. And so we think there's another improvement vector here, which is the amount of intelligence you can deliver per kilowatt is improving. So the amount you can charge to businesses for delivering productivity is improving. And so by merging with xAI, SpaceX not only gets the kind of fixed margin opportunity of launching these satellites into space, but then they get the right side skew, the asymmetric opportunity of packaging that into intelligence to deliver, amazing productivity advances to knowledge workers like you and probably like me and probably like you who's watching this. And so it's a win for SpaceX from that perspective. They get that right side skew. For the xAI shareholder, it's a win because the competitive landscape in AI models is currently and into the future, we think, going to be dominated by access to the underlying AI compute that these companies need to train their next generation of models and serve their existing customers. Every time you play around and generate an image, that's occupying a GPU that then is kind of churning that out for you. Every time you ask it to do a calculation or to create analysis or code, that's occupying these GPUs and churning them out. And in fact, broadly across the market, the companies do not have enough computers to serve all the customers that want to pay them money. And so by xAI combining with SpaceX, it secures future access to the compute power it needs to power its existing customer base and monetize its existing customer base, as well as develop the next generation of products, which will change the software landscape. So from both perspectives, we think it's a win. Now, there are rumors or there've been lots of noise. Well, will Tesla merge with this combined entity? At this point, we don't think that's going to happen, at least prior to the IPO. And there probably is a business logic to it happening in the future. Tesla is gearing up to provide the same chips that it's going to put into its data centers, and its vehicles are going to go into these AI compute satellites. So it's going to be selling chips into this entity. And Tesla already has a reasonably small equity stake in xAI that was, we believe, negotiated in part because it's also purchasing services from xAI and allowing Grok to be distributed through its vehicles. And today you can ask Grok to drop you off at a lunch spot on your route that has great ratings, and it'll figure that out for you and help route your Tesla vehicle towards that opportunity. So we think that there's going to be kind of increasing business ties between the entities. And in the future, it's not unlikely that there will be some kind of complete combination. From the Tesla shareholder perspective, we think that Tesla is remarkably undervalued given it is commercializing robotaxi today, and we think it can scale that business in a profound way, and that'll be very cash flow generative. So we think that we'd like to see the Tesla shares better reflect the future value of those anticipated cash flows before there's a merger between the companies. But ultimately, vertical integration and the combination of the entities makes huge strategic sense because of where we are in the technological economic cycle, where being able to deliver that next technological capability is really dependent upon controlling all of the feedstock that goes into that technology. And Elon Musk has had a lot of success with that over time with his entities, and we think it'll continue to be a dominant strategy into the future.
Yeah, and I'll just add, this is the great convergence. And in our Big Ideas 2026, Brett authored a section called The Great Acceleration. And in that section, you can see a convergent sphere Now, we've been calling this revolution a convergence between and among technologies. But Elon Musk, for the first time, I'm going to say it was 2 or 3 months ago, on X posted that he believed that his companies were more candidates for converging in terms of the various technologies than even he had imagined when he founded them. And so that was a really good clue that we might be onto something when it comes to Elon Musk and all of his companies.
Great. Thank you, Cathie. And thank you, Brett. I know Brett's excited about increasing token uses. His agents are tired. He consumes too many.
Yes, I need more tokens.
Yes. Next one here is Sam. So, Sam, could you please provide us just with an investment thesis update for Acher Aviation?
Sure. First, I'll start with electric vertical takeoff landing generally, because that is really the driving thesis here, which is electric propulsion for these helicopter-like vehicles. And so the promise here is that they are low cost, safe, and a key piece is also quiet. And so that you can get a proliferation of vertiports. And as you know, it'd be great today to be able to have that. But as autonomous cars start to fill the roads and traffic increases, it will become increasingly important to be able to get over short bottlenecks much more rapidly. And so there's this huge promise, right? Just getting to the airport in 20 minutes for the price of a taxi today with this technology. And I'd say, broadly speaking, it's a 2-horse race with Acher Aviation and Joby as well. And so Acher and Joby both have, great headway here in the Middle East. And Acher, I would say, in particular in the US, has seemed to be a favorite from regulators. They're participating in the White House and Department of Transportation eVTOL pilot program, so starting to work with cities to roll this out as soon as next year. And then, we have the Winter Olympics going on now, and Acher is going to be the key provider of electric vertical takeoff and landing transport for the LA Olympics in 2028.
Great. Thank you, Sam. Great to hear about Acher as always. Next question here is David Puel. So David, central to ARK's research is Wright's Law. We've talked about it a lot on this call. How do you apply that methodology to blockchain, such as the cost declines of blockchains, or reach breakthroughs in this field?
That's a very good question, given that blockchain amongst our 5 platforms is perhaps the hardest to map one-to-one a Wright's Law framework to it. So with Wright's Law, you usually have a very clear unit of production, right? Like chips for semiconductors, as an example. As the output doubles, you see the cost decline, and so on. In crypto, however, the unit isn't as obvious. You can ask yourself, is it transactions? Is it wallets? In the case of Bitcoin, is it the difficulty to mine one Bitcoin? So there's not a clear physical analog for a unit being produced here. So the mapping isn't a textbook. However, the core idea behind Wright's Law still applies here. So for public blockchains would be something like, as the networks scale up and the infrastructure supporting them grows over time, there's the cost of doing financial activity in them that declines over time. As very high-level examples, you can see Bitcoin, for instance, where the cost to transact it and custody it used to be, especially at scale, used to be much larger in 2011, for instance, compared to now. And perhaps you see a more clear analog in decentralized finance, also known as DeFi, where you see, let's say, a comparison where traditional finance monetized today at about 3% of the global financial asset base, compared to in DeFi, where you see that number being less than 1%, right? So we think that the unit of production, quote unquote, is more nuanced here. And we can, but we still observe the same principles apply to public blockchains: lower settlement costs, lower intermediation costs as well. In the case of Bitcoin, if you compare it to gold directly, basically no transportation costs and very diminished custody costs. And we see a very proliferating open source environment where, you know, margins are pretty much declining very substantially over time.
An easy way to think about the cost savings here is credit cards. So financial services, I mean, these transactions, there is a cost, 2.5-ish%, 2.5 to 3%, and higher elsewhere in the world, that we think will drop to 1% or less. It doesn't sound like a lot, but it's huge given the trillions, hundreds of trillions of dollars of transactions taking place around the world today.
Great. Thank you, David, and thank you, Cathie. And Cathie, we'll come right back to you. This next question we've been receiving more and more lately. Given the ARK funds are largely concentrated in the US, how do you evaluate the global opportunity set? And if you could please comment on China and Europe specifically.
Sure. So the screen for our portfolios is not a benchmark, not a geographic region. It is our research. And as we do our research on these disruptive technologies, companies present themselves. That's why our portfolios don't look very much like the broad-based benchmarks. We are looking for pure play future winners. Now, a couple of things are going on now vis-a-vis China and Europe. AI is top of mind, of course. Europe, and we've heard this from Palantir, Alex Karp is quite vocal about this at Palantir. We've heard that regulations are a big problem in Europe, and Europe is falling behind in AI developments. China is not. And one of the reasons is, from a regulatory point of view, China is command and control. If Xi Jinping wants China to focus on new productive forces, which is the watch phrase now, that's all about technology. It's go for it. And, regulations are really not an issue, it seems, in China. And by most accounts, China seems to be about 6 months behind the US when it comes to AI breakthroughs. But what's very interesting is that they're even that close. And the DeepSeek moment was very important in terms of highlighting the open source nature or open weight nature of their frontier models. So we have really good insight into what they are doing. Now, why are we more heavily weighted? While we do own Baidu and Alibaba, mostly for the AI opportunity in and around China, we still are very little exposed to China. One of the reasons is we just went through 5 years of a lot of uncertainty, starting after COVID, with the banishing of Jack Ma and the nationalization of online education and curbs on gaming and all kinds of actually regulatory issues. And so we really don't know what we have. We thought it was very important to shift to new productive forces in terms of, the government really wanting technology to take off and wanting to be a world leader in technology. So that's good, but it's a completely different environment from the US. The US did have a regulatory issue, certainly in the Biden administration, the number of regulations, I know there are statistics on this, went up enormously. This administration is all about deregulation, so very positive. It's also very business friendly and capital friendly in that we're seeing really massive tax cuts and massive refunds for both individuals and corporations brewing now. And so we think the return on invested capital in the US relative to elsewhere in the world is probably going to go up. And there's more regulatory clarity, I would say, here now in the US, meaning deregulation clarity than certainly in Europe. So that is why we are have such a big allocation to the U.S. We think the environment, the backdrop is friendly, and our research is pointing us to companies that are breaking through in these new technologies.
Fantastic. Thank you, Cathie. We'll shift gears here over to Frank. So, Frank, how does ARK think about the silicon photonics space from a technology and value chain perspective? And are you currently evaluating any potential investments there?
Sure. Yeah, I think this is a pretty interesting topic. We're seeing the market start to get excited about this when NVIDIA announced last year that they're going to be using silicon photonics in their scale-out networking environment. So silicon photonics is effectively using light to transmit data rather than electricity. And scale-out networking is connecting multiple different units of compute. So say one rack that's doing inference, for example, together, so you can serve a greater number of end users. And we actually have already made an investment in this space in our venture fund, a company called Acher Labs that makes what we believe is the leading co-packaged optic technology. That's silicon photonics that sit actually right on a chip. And they're using this in scale up domain. So that's making bigger computers for AI inference in particular that will blow through some of the speed and bandwidth bottlenecks that are preventing multiple GPUs from talking to each other very quickly. This is important as we're making bigger models, and that's required to reach new frontiers of performance. We're going to hit this wall that copper cables cannot sufficiently move data quick enough in the next couple of years. And Acher Labs is a leading company solving that problem. So we're really excited to have them as one of the holdings in our venture fund, ARKVX.
All right. Thank you, Frank. Our final question here is for Joseph. So Joseph, how has your view on quantum computing evolved, and how do you assess China's progress in the space?
We're excited about quantum computing as a technology, but commercialization is still likely too far out for it to be on our investment radar right now. The fundamental unit of compute in quantum computing is called a qubit. And to give you an idea of where we're at currently, Google has been doubling the number of qubits in their quantum computers and reducing error rate by about 40% once every 4 years. At that rate, we should have a quantum computer capable of breaking RSA encryption, which is one of the more discussed use cases, by about 2063. If we assume progress accelerates to a doubling about every 3 years, then we reach that milestone in 2054. And if we assume that progress accelerates to the same rate that conventional computing has seen under Moore's law, then we should reach a quantum computer capable of breaking RSA encryption by about 2044. So while we're monitoring the space closely, it seems unlikely that quantum computers will see broad commercial applications until at least 15 to 20 years from now. By contrast, the productivity unlocks from AI are already happening and are continuing to accelerate. As a result, we're more concerned with the opportunity in AI over the next 5 to 10 years. And many of the areas that are most likely to be impacted by quantum computing, including cybersecurity, scientific research, financial modeling, drug and material discovery, those are all more likely to see substantial tailwinds from AI before they see benefits from quantum computing. In terms of China-specific progress, there are some Chinese companies with quantum computing efforts. Tencent, for example, does have some research in this area. But just to give an idea of how much AI has sucked the oxygen out of the room here, Alibaba used to have a quantum research division, but they shut it down a couple of years ago to reallocate those resources to AI. So we think that AI is the area to focus on in the near term here, and even internationally, that seems to be the case as well.
Yeah, and I'll just add something here. David Puel, whom you heard from earlier on Bitcoin, has focused on this topic because the concern has made the rounds and is part of the weakness that we've seen recently in Bitcoin's price. He, in partnership with On-Chain Capital, David has written a quantum computing piece as it relates to Bitcoin, and that should be out during the next few weeks. But I think Joseph summarized nicely why we do not believe that Bitcoin even will have issues until 20, 30 years from now.
Great. Thank you, Joseph and Cathie. I'm sure in the next few months we'll have another question on quantum soon. It seems to be a persistent, ask. So stay tuned. And that will conclude the webinar today. We will briefly show performance statistics that can also be found on ark-funds.com. Thank you to everyone who listened to today's call, and thank you again to the entire ARK team.